You know, um, when you walk into a high-end luxury boutique,
Right.
you generally expect to pay an absolute premium for that designer label. I mean, the quality is a given, the stitching's going to last forever.
Yeah, but that price tag is what usually makes you wince.
Exactly. But imagine walking into that exact same boutique during this massive, chaotic thunderstorm that is actively terrifying all the other shoppers away.
You'd probably buy everything you could carry, honestly.
Right. Because the intrinsic value of the item itself hasn't changed a bit. The leather is the same, the craftsmanship is the exact same.
The only thing that shifted were the external circumstances, surrounding the sale. The weather outside made everyone else panic, and, well, panic creates mispricing.
And that dynamic is exactly what we're looking at in today's deep dive. We are unpacking this really fascinating March 2026 Morningstar report that highlights the 10 best companies to invest in right now.
Because right now, the markets are dealing with some serious heavy weather.
Oh, absolutely. There's this overarching, generalized fear about artificial intelligence disrupting entire industries. Couple that with major geopolitical uncertainty, like the ongoing conflict in Iran, for example.
Right.
And look, we certainly aren't taking sides on any geopolitical issues here, but we absolutely have to acknowledge how they actively shape market psychology for investors.
They completely dictate the psychology. But, market fear creates incredible opportunity, assuming you know how to separate temporary turbulence from fundamental weakness.
Yeah.
Being a quote-unquote best company isn't just about having predictable cash flows or smart management. It's about buying that underlying excellence at a steep discount.
So you're looking for those economic moats.
Exactly.
Yeah.
The companies on this list have massive competitive advantages, but because of this broader market anxiety, their stock prices are just deeply undervalued right now.
Okay, let's unpack this.
Yeah.
Because if we're looking for a company that provides literal comfort during a storm, we kind of have to start with Campbell's.
The ultimate comfort food.
Yes, the soup company. But the valuation here is staggering. I mean, Morningstar has them priced at a massive 61% markdown compared to their fair value estimate of $56 a share.
Which is, yeah, that's wild. Price to fair value is at 0.39.
It's the most affordable stock on this entire list. But what really fascinates me is that this isn't just a legacy brand resting on its laurels,
Far from it. This is a 150-year-old institution that is actively mutating to survive.
Right.
Over the past 6 years, they've dramatically shifted their entire portfolio. Like that iconic red and white labeled canned soup, it now makes up just over 25% of their total sales.
Which is a huge drop from, over 40% back in 2017?
Yep. Meanwhile, their snack division has climbed to represent over 40% of their business.
I look at that and I think of someone renovating a classic house. You keep the original foundational soup kitchen because it's culturally iconic, but you spend all your energy building this massive, modern, new snack wing out back.
That's a great way to put it.
But they are doing some brutal renovations to pay for it, right? The report notes they've already realized $950 million in savings through supply chain optimization.
Right, the optimization and tech enhancements.
And now they're targeting another $375 million in savings through fiscal 2028, plus an extra $100 million in overhead reductions.
Yeah.
But wait, if a food company slashes over $1 billion in operational costs, isn't there a severe risk of hollowing out the actual quality of the product? Like the thing that built their moat in the first place.
Well, what's fascinating here is the mechanism behind those savings and where that money is actually going. They aren't just blindly using cheaper ingredients to inflate the bottom line.
Okay.
The cost cutting is specifically designed to fund their future. They're taking those logistical efficiencies and redirecting about 5% of their sales, which is roughly $550 million annually, straight back into research, development, and marketing.
Oh, wow. So they're cutting fat in the warehouses to build muscle in the labs.
Precisely. They are heavily leveraging data insights and AI to track incredibly subtle, evolving consumer flavor trends.
Which lets them move faster.
Exactly. They can bring new snack products to market much faster than legacy competitors. Furthermore, they were using that capital to buy up the premium aisles.
Right, the acquisitions.
Yeah, they recently acquired Sovos Brands, which does about $1 billion in annual sales, and they took a 49% stake in Largena, the maker of Rao's premium sauces.
That is a brilliant barbell strategy. They keep their cheaper Prego brand to dominate the budget-conscious shopper, but now they're capturing the high-end premium sauce space with Rao's.
And they can use their massive, entrenched distribution network to get Rao's onto shelves that a smaller company could never reach. That's how a legacy brand maintains an intangible-based moat in a changing world.
Yeah, they use data to dictate their evolution.
Yep.
But data is pretty useless if you don't know how to wield it. Campbell's is buying external data to figure out what we want to eat. But that leads us directly into our next category of undervalued companies. What if your entire business model is the data?
The gatekeepers.
Right. Companies whose entire existence relies on owning proprietary information that nobody else has.
The information gatekeepers are some of the most resilient businesses on Earth. Let's look at CoStar Group, which the market is currently undervalued by almost half, 0.52 price to fair value.
Yeah.
CoStar's entire business is built on this proprietary commercial real estate database that they've been meticulously building for over 35 years.
It's the absolute bedrock of the industry.
It really is. About 35% of their revenue comes from their multifamily segment platforms you've likely seen, like Apartments.com.
Sure.
And another 35% comes from CoStar Suite, which professionals use for hyper-specific leasing info and property sales data.
And joining them in the data vault is RELX, right? A UK-based company also trading at a steep discount, 0.56. They provide analytics and decision tools for business professionals. I find them fascinating because they successfully made that brutal transition from physical print to digital delivery. Today, 55% of their revenue is purely subscription-based.
And the rest is largely tied up in what the industry calls long-term volumetric contracts.
Right. Explain those real quick.
Yeah, so volumetric contracts are incredibly sticky. It essentially means that a corporate client pays RELX based on the sheer volume of data they consume, rather than just a flat fee.
Like a utility bill.
Exactly like paying for a water utility. The more your business grows and relies on RELX's analytics, the more water you draw from their pipe and the more revenue RELX generates.
Makes sense.
It allows them to target reliable, mid-single-digit organic growth year after year, slowly expanding their margins.
Rounding out this group is Experian, one of the big three credit bureaus, currently priced well below its intrinsic value, 0.60. But they operate pretty differently than their peers, don't they?
They really do. While 67% of Experian's revenue comes from North America, they are aggressively finding major growth by expanding into emerging markets.
Like Brazil.
Yeah, they've established a highly dominant position in Brazil. And unlike Equifax or TransUnion, who usually rent or partner with other tech firms, Experian prefers the much harder route of building its own fintech in-house.
Right, they built platforms like Credit Match and Experian Boost.
Which is brilliant because it lets consumers use their own banking data to improve their credit scores. Plus, they recently fortified their analytics by acquiring a marketing data company called Tapad for $280 million.
Here's where it gets really interesting, though, because that all sounds incredibly dominant. They're basically toll booths on the information highway. But I want to throw a contradiction your way, and I want you, the listener, to think about this too. We have CoStar, who is the undisputed king of commercial real estate. But the Morningstar report gives a pretty stark warning about CoStar's recent expensive foray into residential real estate.
With Homes.com and HomeSnap.
Exactly. The analyst actually calls it an expensive and value-dilutive distraction. Right. And then we have Experian pouring capital into emerging markets where the report explicitly notes the payoff is uncertain. Are these data giants struggling to stay in their lane?
It's the ultimate capital allocation dilemma, honestly. Think about the mechanics of growth. When a company utterly dominates its core market,
like CoStar in commercial.
right, or Experian in U.S. credit, they're essentially run out of easy runway. There are only so many commercial buildings to track.
True.
So to keep showing massive growth to their shareholders, they're practically forced to seek out riskier adjacent markets. CoStar moving from commercial to residential sounds logical on paper, but commercial is business to business.
And residential is business to consumer.
Exactly. It requires a completely different marketing muscle, taking them far beyond their core competency.
Which perfectly explains why the report praises RELX so much. They aren't trying to build a consumer brand. They just quietly increase their margins by sticking strictly to professional workflow analytics.
Right. They avoid the flashy, dilutive acquisitions. It's less glamorous, but structurally sound.
Well, speaking of structures, collecting mountains of data is really only half the battle. If data is the new oil, our next group of companies are the refineries.
The cloud and software titans.
Yes. And despite the AI fears causing market volatility, these tech titans are actually the ones driving the AI revolution. Let's start with SAP,
The world's largest enterprise application software provider.
trading at a huge discount, 0.52. They are aggressively transitioning away from on-premises to the cloud, offering Rise for large enterprises and Grow for the mid-market.
And they're using that classic land and expand strategy.
Which is so lucrative. You land a mid-market customer on your base platform, and because all their data is native to your cloud ecosystem now, it's incredibly frictionless to upsell them later.
You expand your footprint by selling them HR software, supply chain analytics.
It's just like the smartphone ecosystem. You buy a basic phone, but a year later your storage is full, so you pay for their cloud upgrade. Then you buy their premium apps, their wireless headphones.
Because third-party ones don't sync as smoothly.
Right. Before you know it, leaving that ecosystem means abandoning your digital life.
And no company on earth has perfected that ecosystem lock-in quite like Microsoft. 0.59 price to fair value, which is a 41% discount to its $600 fair value estimate.
Azure is the centerpiece there, right?
Absolutely. Azure is an approximately $75 billion business, and yet it's still growing at 30% annually. They're leveraging their massive installed base to transition customers to the cloud effortlessly.
Upselling Office 365, utilizing that huge AI advantage via OpenAI. But I look at their portfolio and see a potential vulnerability. They're building enterprise AI, but they are also shifting gaming to the cloud.
Yeah, the Xbox ecosystem.
Is there a genuine risk of Microsoft spreading themselves too thin across enterprise AI on one side and consumer entertainment on the other?
Well, if we connect this to the bigger picture, the underlying computing architecture powering both of those things is actually identical. Microsoft, SAP, and our next company, Dassault Systems, all rely on the exact same protective moat.
High switching costs.
Exactly. Dassault's a fascinating one, by the way. 0.60p to FV. They are the world leader in mechanical CAD software.
Right, they have Katia for aerospace and auto.
SolidWorks for mid-sized companies. Metadata for clinical trials. And right now, they are shifting everyone to their 3D Experience and 3D Unit IV plus RSES platforms to monetize generative AI.
Targeting 7 to 8% annual revenue growth. So to answer my own question about risk, the moat really is the friction. Once a hospital system uses Dassault's metadata or an enterprise migrates to Azure, the operational nightmare of switching is so paralyzing they just stay locked in.
The pain of switching is higher than the cost of staying.
Now, building an inescapable ecosystem makes sense if you're a famous tech giant like Microsoft. But our next category proves you can also do it by utterly dominating a highly specialized, totally unglamorous niche.
The niche dominators.
Think about this. How often do you consider the logistics of corporate proxy voting or the supply chains of ostomy care?
Probably never.
Right. And that anonymity is their secret weapon. Take Broadridge Financial Solutions. They spun off from ADP back in 2007, and for over 20 years, they have been the dominant proxy and interim services provider for broker-dealers.
It's massive. Over 30% of their revenue comes purely from tech and operations.
And then there is Coloplast, a Danish medical device company. They lead the global market in ostomy and continence care, and their efficiency is just staggering.
It really is. They shifted their highly technical production to specialized hubs in Hungary, China, and Costa Rica. Because of that, their gross margin beats their main rival, Convatec, by over 1,150 basis points.
Wow, an 11.5% margin advantage.
Yeah, in manufacturing, that is a canyon.
But reading through the Morningstar report, both of these niche dominators have raised some red flags. Broadridge acquired Activity for $2.5 billion, which the analyst flagged as pricey.
Very pricey.
And Coloplast is actually struggling pretty badly in the wound care market due to Medicare reimbursement issues and pricing pressure on their low-tech foam products. Are they getting too confident outside their main territories?
Well, that's the perpetual danger. Having exemplary capital allocation, which Coloplast generally has, means knowing when to innovate, like their new Lou-Shea catheter, which reduces infections. That's real innovation.
People will pay a premium for that.
Exactly. But you also have to know when to pull back from commoditized markets, like that low-tech wound care foam. When your product is a commodity, your moat evaporates.
That is a vital distinction. Now, while Broadridge and Coloplast found success by defending their niches, Our final company survived by doing the exact opposite. Over the last decade, they completely changed their identity.
Sony Group, currently sitting at a 0.61 price to fair value.
For decades, Sony was synonymous with consumer electronics, but relying purely on hardware volatility is exhausting.
It's a brutal business model.
Mhm.
So they executed this massive corporate pivot to reduce that volatility.
Right, so what does this all mean? I look at Sony like a brilliant actor who stopped trying to be an action star relying on volatile hardware sales and became an Oscar-winning director. Today, their profits are heavily driven by music, movies, and gaming.
PlayStation is actually their largest revenue generator now. They successfully migrated their massive user base from the PS4 up to the PS5.
They haven't abandoned hardware entirely, though. They're still dominant in image sensors for smartphone cameras.
Oh, that requires really high capital investment in R&D.
Mm.
But they strictly manage their TV business now, focusing only on premium products and tight inventory to avoid losses.
Okay, but I have to push back on the idea of content being a safe haven. The report mentions rising game development costs and fierce competition from PC platforms like Steam. Is Sony just trading the volatility of the TV market for the hit-or-miss volatility of the blockbuster video game market?
This raises an important question, actually. While an individual game or movie is inherently a hit-driven product, Sony isn't just selling individual games, they're building an ecosystem.
Right.
When you own PlayStation subscriptions or you own massive music catalogs, you're collecting recurring revenue. It provides a baseline that selling one-off digital cameras simply never could.
Which brings us full circle today. We've covered some incredible ground for you. From Campbell's Snack Pivot to the data moats of CoStar and Experian, the cloud dominance of Microsoft and SAP, the niche monopolies of Broadridge and Coloplast, all the way to Sony's entertainment evolution.
It's a really diverse list.
It is, but the common thread: high-quality cash flows, smart management, and currently, a steep discount.
I want to leave everyone with a final thought to mull over. The very premise of this Morningstar list is that widespread fears over artificial intelligence disruption have sparked market volatility, right? That's what's making these stocks cheap.
Yeah.
Yet, companies on this exact list, like Microsoft, SSP, and Dassault, are aggressively wielding that exact same AI technology to build their future platforms and deepen their own moats.
Oh, wow.
If the broader market is fleeing in terror from AI, but these specific high-quality companies are already utilizing it as a weapon to guarantee their dominance, are investors mispricing the cure as the disease?
Mispricing the cure as the disease. That is a phenomenal lens to view this through. The next time you look at your own portfolio, try viewing the market turbulence through that exact framework. Look for the structural quality hiding quietly behind the temporary panic. Thank you so much for joining us on this deep dive, and we'll catch you next time.